There's a dividend stock that's been dividing the high-yield investing community for more than a year at this point, but the conversations surrounding this company have only elevated over the past week given their most recent earnings report. NextEra Energy Partners, ticker NEP, had their second quarter earnings announcement on Wednesday. According to their Q3 results, the company posted a loss of 43 cents per unit, which is down from 57 cents per unit in the same quarter last year, while Q3 adjusted EBITDA fell 7.2% year-over-year to $453 million. Operating revenues fell 13% to $319 million, and cash available for distribution plunged 37% last quarter to $155 million. These financial results came as a major shock to shareholders, and the share price per unit fell by almost 16% on the day the earnings were released. Their year-to-date performance when looking at their share price, or unit in this case because it's a partnership, is down over 31%. But on the same day earnings came out, NextEra Energy Partners also did something that was very surprising. Despite their terrible earnings, the company raised their dividend by 1.4%, coming out now to 91.75 cents per unit per quarter. This gives NextEra Energy Partners a dividend yield that exceeds 17% at this point. Looking at their distribution history, you'll see this company has raised their payout every single quarter for over a decade at this point. The amount they raised their most recent distribution was the exact same amount as they typically grow it every quarter. And according to Seeking Alpha, they have a 5-year dividend growth rate of 13.29%, far above average for a dividend stock. Furthermore, their CFO made the following quote on their earnings call. Between 2023 and 2027, we continue to expect that our average annual growth in operating cash flow will be at or above our adjusted earnings per share compound annual growth rate range. We also continue to expect to grow our dividends per share at roughly 10% per year. So what exactly are we to make of this? Normally when a company raises their distribution, it's a sign of confidence by the board of directors. In this video, we'll take a look at NextEra Energy Partners in depth and try and determine what the future might hold for this company. Is what we're looking at just a temporary setback and this represents a good buying opportunity, or is it a sign of a much bigger problem for this company? NextEra Energy Partners acquires, manages, and owns contracted clean energy products with stable long-term cash flows. They own interests in wind and solar projects in the US as well as natural gas infrastructure assets in Pennsylvania. For about a decade at this point, NEP has been a popular stock for people who love both a growing dividend and also want a green investment in their portfolio. It's been one of the best ways for high-yield investors to take advantage of the green energy boom. Really, a dying form of company is called yieldcos. These are pretty similar to REITs and master limited partnerships, only instead of owning real estate and oil pipelines, yieldcos own green energy assets, and they're also required to pay out most of their earnings in dividends to their shareholders. They've been around for many years, but I would honestly say that sometime around 2012 or 2014, a lot of them just started getting acquired or merging with other companies. And as a result, not too many of these kinds of companies exist anymore, so people who like both a high-yield investment and want to diversify into these kinds of green energy companies don't have too many options left available to them. Even though NEP might look like a master limited partnership because it says LP common units in their stock's title, according to their website, investors receive a regular 1099 DIV tax form, so there's no Schedule K1 or anything special like that here. So like I was saying, it might seem like this company would be a worthy consideration for a dividend growth investor. There's been a craze going on for green energy production, and their dividend has grown every quarter for a decade. But let's take a closer look at what's been going on with NextEra. The issues with this company really started about 13 months ago. Their stock had been falling for a bit before then, but a lot of that was due to rising interest rates. As you can probably imagine, this company has a lot of very expensive assets that they have to maintain and upgrade on a regular basis. So just like with REITs and communication companies, among many other types of businesses out there, these green energy businesses saw sizable increases in debt expenses. But now that rates have been going down, these companies that own expensive assets have been recovering in share price, but NextEra hasn't. On September 27th of last year, NextEra Energy Partners announced that they were significantly lowering their original growth expectations on their company to 5 to 8% per year through at least 2026, with a target growth rate of 6%. This was much lower than what management had previously said several times, which is that they were expecting up to 15% growth annually through at least 2026. The announcement shocked and disgusted the market as many were surprised the company's management team would make such a statement after as recently as July of that year, saying that they were really optimistic about their company's growth. Between September 22nd and October 3rd of 2023, the share price of NEP dropped by more than 53% following the management team's change in optimism. In the months preceding that, things slightly improved for NEP as they were likely benefiting from lower interest rates along with the sector as a whole. But then finally on Wednesday is when they released their most recent earnings results. To summarize everything they reported, in Q3 their EPS was negative 43 cents. That's significantly lower than what they were expecting, which was a positive EPS of 87 cents. Revenue was also reported to be $319 million, a 3.6% year-over-year increase, but still missed expectations by $22.17 million. Likely the most concerning issue for dividend investors is their fall in cash available for distribution. In just one quarter, it fell by 37%. Despite these results, again, the company did announce a dividend increase. So now let's go ahead and get a better understanding of how this company makes its money and why things have taken a serious downturn. And it is a bit of a complicated strategy that they've got going on here, so I'll do my best to simplify it. NextEra Energy Partners was formed by NextEra Energy, ticker NEE, back in 2014. And they happen to have a very intimate strategy going on with their green assets. NextEra Energy, NEE, is the one that acquires the green energy assets and will then split the assets almost 50-50 with NEP. NEP has to pay NEE for their half of the assets, and they receive half the income that's generated from them. In order for NEP to keep buying NEE's green assets, they have to keep raising capital. At their historic rate of growth, they wouldn't be able to grow fast enough from just using the profits generated from their green electric assets. So NEP has two different choices. They can either issue new shares of their stock, or they have to take out debt. The strategy isn't necessarily terrible, but there's a huge issue they've got going on. Because this company has to borrow large sums of money to acquire the assets from its parent company, it's very interest rate sensitive. When NEP was launched about a decade ago, interest rates were close to zero. Ever since rates went up after COVID, it's been a serious issue for this company. NEP has been under serious pressure from much higher interest expense. And again, it is good news that rates have started going down, but the Feds have made it clear that it's very unlikely we'll return to a near zero interest rate environment for a very, very long time. Based upon what I'm seeing, there's only two ways this stock could recover in a short amount of time. Either the Feds need to go against what they've been hinting at and they need to cut rates very, very quickly, or their parent company, NEE, needs to slow down on acquiring more green assets. If they were to slow down, then NEP would have to stop growing their dividend because the growth we've been seeing up to this point has just been way too fast for them. And their parent company hasn't shown any signs or given any indication that they want to stop acquiring assets. NEP basically has a bit of a toxic relationship with NEE, and at the rate they're going, the potential for a dividend cut is likely. So in the end, I'm not optimistic about the near future of this stock. I think that once we do get more rate cuts, and if their parent company slows down on the green acquisitions, then I think NEP could be a more attractive investment. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.